Traders Corner is brought to you by IG.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, your trade last week for the portfolio was Naspers, and we're going to talk about that in a moment. But I know you want to tee us off by having a look at the US markets, the S&P 500 and the Dow Jones.
That's right, Joe. We always generally do start with a look at the S&P 500, and this week I also want to bring in the Dow Jones Industrial Index, or the Dow Jones Industrial Average, actually. And they've got a very similar chart structure, the two of them, which is kind of what you would expect. But what I want to really hone in on is the trading dynamics and the shape of the graphs, and why I think there's maybe just a little bit of reason to be moderately cautious on these US markets. So the chart of the S&P 500 is up on the screen at the moment, and what's very clear is that we've got this lateral support, which is down at 2120. That lateral support line goes back a long way. If I were to zoom out on the chart, you'd see it goes all the way back to early 2015. So it's a very strong support level. It's also a rather obvious support level, and sometimes the most obvious supports might not always necessarily hold as easily as you might expect. It's just sort of the nature of the market sometimes, that the obvious things sometimes don't always happen. And if I look at this chart, and I sort of look at it in isolation, I'm not looking all the way back to the left where this 2120 support goes to. You know, there's a pattern of lower highs over there. You can see that indicated quite clearly with the arrows pointing to the downside there. And what that really is telling you is that the sellers are quite strong. Each time the market gets up and rallies a bit, it's faltering at a lower level. Yeah. And what's that's telling you, obviously the buyers are not strong enough to push it up to new highs, and the sellers are coming in at a lower price every time. And if you had to say to me which of the two forces between buyers and sellers are stronger here, I'd have to hand it to the sellers ever so slightly because of that fact. And also given the fact that, look at our 50-day moving average, that's that blue line over there. It's begun to roll over, and it's now actually pointing downwards. And you can see that every time the S&P 500 has rallied up to the underside of that 50-day moving average, it's actually found resistance, and the sellers have come in to push it lower.
The thing is, though, it's still well above the 200-day moving average.
It is still well above the 200-day moving average, that's right. And my sense is that if we were to see it breaking down below that 2120, then it would probably quite quickly move down to the 200-day moving average. And I'll show you, I mean, let's just have a quick look at the Dow Jones Industrial Average as well. So this is a very similar looking chart. You can see that the shape of the graphs are pretty much identical, really. And here we've got lateral support on the Dow at 18,000. And you can see that each time the markets come down to that area, the buyers have stepped up and they've pushed the price up off that support. However, again, we've got this pattern of falling highs over here. And we've got a 50-day moving average that has begun to roll over, and it's pointing downwards. And every time the Dow rallies to the underside of the 50-day moving average, it's finding resistance at that level. So for me, these two charts both suggest, look, we know, first of all, that they're pretty much range-bound and sideways. But if I have to distill out and say which of the forces are stronger, I think the sellers are by this evidence, are looking as if they're slightly stronger here.
I mean, it certainly doesn't denote massive amounts of confidence because the buyers would be coming in and picking up those shares. And also, we've had US earnings season. Well, it's drawing to a close.
Yep.
And that should have support. You know, if a market were going to draw some support, that theoretically should have been one of the factors present.
Yeah, well, that's it. But also remember, the markets do look forward as well. And it's probably also looking out to next year's earnings. And we'll talk a little bit about that now, because I also want to look at the chart of the US dollar index, and I'll do that in a moment. But before we get there, what I want to look at is the chart of the gold price, and I want to tie this back to what we've just seen there. And I mean, look, let me make it quite clear. There's no direct link between the gold price and the US stock indices.
I'm not sure how you're going to wangle this one.
So don't get me confused. I'm not saying there's any link between them fundamentally or any other way. The only reason I'm showing you this chart is just because of the shape of it and the fact that the trading dynamic that we're seeing on the US indices is actually quite similar to what we were seeing on the gold price before it broke down recently. So have a look at this gold price chart. You can see it's the same sort of setup. We've got this lateral support, which was at $1,310 an ounce, and then we had this pattern of falling highs for about 3 months. Every time the gold price rallied, it was making a lower high. And that was telling you that the likelihood was that when this pattern eventually resolved itself, the prospect of it actually breaking to the downside was fairly good. And again, you had a 50-day moving average that had begun to point to the downside. Every time the price rallied up, it found resistance at the 50-day moving average, and it came back down. And then eventually, what happened at the beginning of October was we got the sudden breakdown in the gold price. And you can see that was a classic break of a support level. There you've got your 1,310 lateral support. That breakdown was very violent. I mean, I was sitting in front of my screen watching that the one afternoon, and I was amazed to see how quickly the gold price dropped. And that, if this is, if we try and link this back in any way to those US markets, all I want to make the point is that from a trading dynamics point of view, I think we're seeing something quite similar. If we look at that S&P 500 chart again, there you can see it again. It's got lower highs, a flat support level. If this thing's going to break one way or the other, I won't be entirely surprised if it actually does break down at some point.
And that goes back to your beginning point about a sort of a well-entrenched support level actually not offering any support whatsoever, which is the case in gold.
That's it. So once it actually breaks, all of a sudden you can find that there's a vacuum underneath that level, like we saw in the gold price, where once that support level gave way, the sellers just pounced and there were no buyers to prop the price up. And my suspicion is that if we were to see these US indices breaking those support levels, then we'd probably quite quickly get down to the 200-day moving averages. And on the S&P 500, that comes in at around about 2073 at the moment.
You mentioned the US dollar index. How would you kind of square that back with what's happening on the S&P 500 and the Dow? Yeah,
so the US dollar index is interesting from this point of view because this is an index that tracks the value of the US dollar against the basket of its other developed market trading pairs. So the major pair in this US dollar index is the dollar euro. I think that makes up about 57% of the weighting in the US dollar index. And then you've got other currencies like the pound, the yen, the Swiss franc, the Canadian dollar, and I think the Swedish krona is the other one. There's 6 currencies that make up this index. Anyway, it's an index of how strong the US dollar is against its trading partners. And what we've got here is quite a powerful technical break that happened on the move above 96 on the US dollar index. That happened at the beginning of October. And you've seen the US dollar rallying quite significantly since then. And it looks to me as if we're going to go and probably push up against the upper end of this channel, which will take the US dollar index up to around about 100. Where there's a big overhead resistance area. But the way I tie this back to the US indices, the S&P 500 and the Dow, is that remember that those indices are very much heavyweight indices. A lot of exporting companies are in those indices. And if you've got a strong US dollar, then the likelihood is that that's going to actually be a headwind for earnings for those big global companies that are listed on the major US stock indices. So keep this in mind because a strong dollar theoretically is actually a headwind for US earnings.
Yeah, so it would tie in with any sort of breakdown in the market.
It would, yeah.
And what about our own market?
So this is our top 40 index, and it's been making lower highs and lower lows for the last little while, actually. You can see that quite clearly over there. If we look more specifically, and we've got about, 6 months worth of trading action here, 44,000 is an important support level that's been tested in June. That was at the time of Brexit. And then again, recently in the middle of October, that 44,000 support was tested again. Now, what gets my attention here is the fact that we've got quite clear evidence of selling pressure happening at the underneath of the 200-day moving average and the 50-day moving average. Those are those lines there. There's the red one that I'm pointing out now. That's the 50-day moving average, and the green one is the 200-day moving average. Now, notice the candlestick patterns on the daily candles that we've seen over the last 3 days here. There are long tails to the upside on those candles, and what that implies is that at some stage the market was at quite an elevated level, but it couldn't hold those gains into the end of the day. It sold off into the end of the day. We're seeing it again right now as we sit here on Tuesday afternoon. So what that's telling me is that the sellers are active at the upper levels. They are acknowledging the fact that there's resistance at the underside of the 200-day moving average. And we've got a little rising wedge pattern forming over there. And if we start to see the market breaking down below the bottom of that rising wedge pattern, then I think there's a good chance we're going back to 44,000. And who knows, we might even go and take that support out at some stage in the next little while.
And just remind us then how you're exposed, because you have exposure on both sides, long and short of the market.
Yes, that's it. So we've got a put spread option structure which works below 46,500, which is that level I'm pointing out on my graph there now. So we are well in the money with those put options. But I also did go and put a 50% long position on by buying 5 all-me futures. So in essence, what it means is that I'm long 5 Rand per point if the market goes up, and I'm short 5 Rand per point if the market goes down. We've got a V-shaped payoff, which is quite a nice situation to be in. My gut instinct is we might still have another leg to the downside, but it's kind of nice to have both sides of the fence covered.
Yeah. Okay, guys, so that's a general look at the market. And now a trade that you put on for the portfolio last week. You haven't been that active in the market this year, and it has been a very sort of tricky market, and one is frequently sideswiped. But the Naspers trade seems to have worked out quite well for you.
It has worked out well. Could have worked out even better, actually, but I sold probably a bit too early here. But I think in the spirit of hitting singles, like we've done all year, this is another single, so they all add up. I think this one adds about 1.5% to our trading capital, which is decent. It's better than a poke in the eye. What we've got here is the channel that Naspers has been trading in all of this year. You can see that's quite clearly evident. I did say in previous shows that I was expecting the share price to come down to 2,200, which was the bottom of that channel, and that it would most likely find support there, and it would probably bounce up off of that level. And if it got there, I'd look to buy it. So I stuck to my word. Last week we went long of 50 CFDs in Naspers at 2,272 Rand. My stop loss was quite wide here, 2,190. There was the reason I put that stop loss wide was because I didn't want it to get in the way of any short-term noise. The stock did move higher, and I decided to sell it at 2,353 Rand. That was on Friday. The reason for that was because, like the top 40, the share price graph of Naspers was making these long tails to the upside, implying that the sellers were active. And that was round about the area where the 50-day moving average comes in. So I thought, I'm not going to be greedy here. Let's bank a quick profit. We'll hit a single, as it were. We make 3,351 Rand here. So not a lot of money, but it certainly adds to the performance of the portfolio.
I mean, yeah, you'd be gnashing your teeth because yesterday it went to, 2,404 Rand. That was the close yesterday,
Yeah.
although today it has now come back below that level.
Yeah.
I mean, just a point on Naspers. If it doesn't manage to pierce, I suppose 2,400 thereabouts is actually where the 50-day moving average is.
Yeah, just below.
Just below. If it fails there, that also has quite negative implications for the whole market, given that it's got such a heavy weighting.
Correct. Naspers makes up about 19% of the weight of the top 40 index at the moment. So if Naspers comes off hard, you definitely feel it on the value of the top 40. I think every 5% move on Naspers equates to about 450 points on the index.
And just maybe a last comment on Naspers. Having sold quite quickly, is that to some extent symptomatic of your psychology as a trader this year? Is that you take the profits when you get them, and you don't wait to run your profits, which is always kind of a golden rule in trading, but it hasn't been that kind of year. Clearly.
It hasn't been. We've struggled to run profits this year, and sometimes where we've had profits that we've tried to run, they've been stolen away from us by the market. So I think, it was definitely a psychological decision just to take a bit of money, put it in the bank, claim a profit, because we haven't had one of those for a while. So I think it was maybe a little bit of psychological massaging of the ego and just ticking away and keeping the profit ticker turning over.
Yeah. Okay, guys, so what does the portfolio look like in that case?
All right, so here we sit. We are literally pennies away from 300,000 Rand on the portfolio. Remember, we start the year with 250,000 Rand. So we're up almost 20% for the year to date. You can see the 3,500 Rand profit that we made on Naspers. And then we've got our option structure, which is in the money, 5,900 Rand in the money. And then we've got that 50% long position in the December All-Me futures. We're slightly underwater on those. But overall, that's quite a nice place to be in. So we've just got the options and the All-Me futures at the moment for our portfolio.
Yeah. And then to end off with your next course dates and also how to subscribe to a weekly email.
Yes, so I've got high probability trading courses coming up in Johannesburg and in Cape Town in November. You can see the dates there. And then my colleague Andrew Todd is running a top 40 trading course on the 12th of November. Anyone that would like to attend any of these courses, please email me, garth@traderscorner.co.za, and I'll send you all the details. And then lastly, our free weekly email list. If you'd like to get a heads up to what's coming up on the show each week, you can go to traderscorner.co.za and subscribe to our free email, and you'll get a mail every Tuesday afternoon.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.
Traders Corner is brought to you by IG.